If you're trying to trade options consistently, there's a couple of components you need to be aware of and how that relationship works. So this way you can see, hey, where do I give a little bit to get something else? Because that's what options trading is there's trade-offs. There's for every give me, there's kind of a gotcha. So I'm going to share with you this little grid, give you a little bit of insight and perspective. So this way you can see, hey, what is it that I want? What am I looking for? And then what am I willing to give or give up in order to get that thing. Now, if you're brand new here, I'm Sasha, the options coach. Been trading options for quite a long time and coaching over the last decade here. Now, in this trade recipe here that I want to share with you, we're really looking at a combination of factors. So at any trade you do when it comes to options trading, you're going to have a few components here. So think of it like, okay, if I put a little bit of this, what am I going to get? Or if I want it to be a little bit more like that, what am I willing to give up, right? So if you want a certain recipe to be a little bit more chocolatey, what do I need to get the chocolate? Well, I got to put in chocolate, but what am I going to have to give up? Well, you might not want to put like other factors in there like jam or something like chocolate and jam. Sometimes it can work, but you know, if you want more and more and more chocolate, like you want a chocolate heavy item, you're going to put less and less of some of the other stuff in there. So my point here is that the same thing goes in the options world where, hey, if I want a lot of reward, I might have to go in and put a lot more risk into the mix, right? Or if I want high degree of probabilities, well, in that case, I might need to go in and have more risk. So there's a balancing factor in here, and all of these little items have kind of like a little bit of a scale behind it. So if you want to get something, you have to give up something in somewhere else. Now, the good news is there's a lot of different strategies that kind of can fine tune some of these things where you can do different combinations of trade-offs, but that's really what you're doing when it comes to creating and composing trades. And I want to show you kind of this example of how this really works at a basic level. So let's say I want something with a very high degree of probability, and we'll just talk about something as simple as selling a put way out of the money. So if we want a high degree of probability, so a high prob, okay, we'll go and we will sell a high probability, which is a low delta put. So we're going to sell that put. Now, in order to do something like this, we might only get 10 cents or 20 cents compared to maybe $2. Okay, you're going to get a lot less when you have high probability, but you have a high win rate. So here's an example of selling a put. The price might be over here. So we've got price way further out, but the problem is you know, our reward might be only $20 for a risk of maybe, I don't know, $20,000. So you're not making much, but your chance of reward is very high. So you're saying, hey, I want high degree of probabilities. I want a really nice probabilities. My risk is going to be high because I want a high win rate, but my reward is going to be very kind of stinky. And I'll show you how this works here in just selling kind of a put on, well, we could stick to coin here. And to have a high degree of win, okay, I can go, well, let's take an 11-day. Right now, the current stock price is 254. Well, if I want to have a really, really, really good chance of winning this, I could say, well, I'm willing to buy that stock way out here at 210. Well, that's almost 40 points lower. Okay, the expected move here is only 20 points. But at 210, I'm only going to make $30. Now, the delta is only a 3. If I want to increase that and make more, well, now by saying I want to make more, well, that's saying I want a bigger reward. If you want a bigger reward, we have to trade that reward concept for the probabilities, meaning we're going to have lower probabilities of that, but at least we're going to get a better reward. So by going now closer in saying, okay, well, instead of this 210, I might say, well, I want to make more. I want to make $200. Well, I could sell it here, but now my delta over here is a 16, which means the probability of touching that is about 37%. Meaning touching it, and it could, the expiration is a whole different ballgame, but it's about 37% of touching it. If we look for probability of out of the money, okay, we still have some pretty good probabilities, 80% expiring probability, 80%. So that's pretty good, but not quite as good as 96 over here that we had earlier. So the thing is that I might say I want a bigger reward, but if I want a bigger reward, I'm going to have stinkier probabilities. And this is what the recipe is kind of showing you and giving you a little insight in here, is that you have this give and take relationship. Okay, and you have to look at these different components as far as risk goes, reward, probabilities, time, volatility, and capital. So for example, if you want to be in the trade a shorter duration, let's say you want to make money faster and you want to repeat the process. Well, if I want to be in those trades shorter duration, I might have to take on more risk or a lower reward because there's not as much premium. And I'll show you this concept in here. So let's say I go in for this 11-day. If I want to be only in that trade 11 days for let's say 230. Okay, for a 230, I make about $1.39 if I'm selling that single option contract. For 11 days, 230. Okay, I make $1.39. But if I go 24 days for the 230, I make about $4. So you can see what the difference is here is one is, let's see if I can pull it up at the same spot. Okay, almost there. Okay, 230 right there. It's about $1.40 versus 230 right down there. There we go. I can actually get it in the same frame. Okay, so here in this frame, we have a $4 that we can actually make, or $400 for that option premium. So that is the 230 right there. So we got $4. Okay, whereas the 230 over here is I make $1.42. So if I want to do a shorter duration, yes, it expires faster, but I only get to make $1.40 in that one. Whereas the other one at the 230, I get to make $4 or $400 on that one. So you can see shorter duration. If time is more of importance to me, well, yes, I could do the shorter duration, but I have to kind of give up or not make as much, because, well, now I'm in the shorter duration. So there's always this give and take in the marketplace. And that's what I wanted to show you in this little visual here, is that we have some of these components that we can tug and pull and say, okay, I want greater probabilities. Okay, fine. You want greater probabilities. Well, what are you willing to give to get some of those greater probabilities? Or I'm willing to take a lot less of a risk. Well, if you want to take less risk, it means you might need to use more capital or something like that to make the same amount. So all of these components work hand in hand. And I want you to think about how you're doing your trades and how each one is modifying your trade, your capital, your time, your volatility, how it changes that parameters. So anytime you tweak something or modify or change it, it's going to tug and pull on some of the other components. So, and this is what a lot of people don't get, is they think, okay, well, I'm going to, I want a low risk strategy with a high reward and a high probability. It's not usually going to happen. It's very difficult to find those kinds of trades, right? Especially and you want it to be in the shortest duration possible and not use any money. Well, now you're asking for a lot, because the marketplace doesn't have a lot of give-me's. But if you start thinking on this relationship of okay, well, I'm willing to do this and give up something here in order to get that, then that's the way you can start approaching trades and strategies. And that's what a strategy really is it's a combination of these things. It's a modification. So, like a butterfly trade versus an iron condor trade versus a vertical spread or selling put premium. They all are just a combination of variants to these. That's all you're really doing, is you're modifying one of these things, or you're saying, hey, I want to focus on this one thing. I want to trade that benefits when things are more volatile, or I want to trade that benefits that uses less capital. I want to trade that benefits, with a high reward or something like that. So all of these things is just okay, am I focusing on something, or am I trying to reduce one of the components? And that's how you start thinking as a better trader. That's how you start looking for more consistency and seeing different trades. This is how you evolve further. So, because it's not just one thing and you're not going to get everything. So I hope this gives you a little insight. If you're interested in some of the classes that we've got, check them out. We've done a lot of different things from profiting and building kind of businesses within trading. This is one of the classes we just did not too long ago. It's the trading bucket strategy and concept. So I highly encourage you to check that one out. Anyways, thank you so much for joining me. Truly appreciate it. Check out our website, optionsblackbelt.com, and I will see you in the next video, maybe even a live class. And see you next time. Take care.